Obtaining an in-depth understanding of the entity, its operating environment, and the applicable financial reporting framework is a fundamental component of audit planning and risk assessment. ISA 315 Identifying and assessing the risks of material misstatement requires auditors to obtain sufficient knowledge of the entity and its environment to identify and assess risks that may lead to material misstatements in the financial statements. This understanding provides the basis for designing an effective audit strategy and determining the nature, timing, and extent of further audit procedures. It enables auditors to recognize significant business risks, evaluate the effectiveness of internal controls, understand management's accounting policies and estimates, and identify transactions or balances that may require additional audit attention. Without adequate knowledge of the entity, auditors cannot properly exercise professional judgment or respond appropriately to identified risks. The process of obtaining an initial understanding begins by gathering information from both internal and external sources. Auditors review prior year working papers, previous financial statements, budgets, management accounts, board minutes, internal control documentation, and internal audit reports where available. Discussions with management and those charged with governance provide valuable insight into strategic objectives, business operations, financing arrangements, significant contracts, and major developments during the reporting period. External information is equally important and may include industry reports, economic conditions, competitor analysis, regulatory requirements, stock exchange announcements, press releases, and information obtained from professional databases. Together, these sources enable auditors to develop a comprehensive understanding of the entity's operations, ownership structure, governance arrangements, and business model before substantive audit work begins. Understanding the entity's environment requires consideration of both external and internal factors affecting business performance and financial reporting. External factors include economic conditions, inflation, interest rates, exchange rate movements, technological developments, government regulation, industry competition, and environmental or political risks. Internal factors include organizational structure, corporate governance arrangements, financing methods, information systems, internal controls, accounting policies, management philosophy, operational processes, and performance measurement systems. The auditor also considers business objectives, key performance indicators, risk management processes, and sources of revenue generation to identify areas where management incentives or business pressures may increase the risk of material misstatement. Such knowledge assists auditors in identifying unusual transactions and significant judgments that warrant enhanced audit procedures. An equally important aspect of planning involves understanding the applicable financial reporting framework, which establishes the accounting principles used in preparing the financial statements. For most entities, this framework consists of International Financial Reporting Standards, IFRS, or relevant national accounting standards. The auditor must evaluate whether the chosen framework is appropriate for the entity and determine whether accounting policies have been consistently applied and adequately disclosed. Understanding the reporting framework enables the auditor to assess the appropriateness of recognition, measurement, presentation, and disclosure requirements while identifying areas involving significant accounting estimates or management judgment. Compliance with the applicable financial reporting framework is essential for expressing an opinion that the financial statements present a true and fair view. Analytical procedures represent one of the principal planning techniques used to develop an understanding of the entity and identify areas of potential audit risk. Analytical procedures involve the evaluation of financial and non-financial information through the analysis of plausible relationships among data and the investigation of unexpected fluctuations or inconsistencies. During the planning stage, auditors compare current year financial information with prior years, budgets, industry averages, forecasts, and expectations developed independently. Significant variations may indicate errors, fraud, changes in business conditions, weaknesses in internal controls, or unusual transactions requiring further investigation. Consequently, analytical procedures enable auditors to focus audit effort on high-risk areas while improving audit efficiency and effectiveness. The purpose of planning analytical procedures extends beyond identifying unusual movements in financial data. They assist auditors in developing expectations regarding financial performance, understanding business trends, evaluating going concern assumptions, assessing the reasonableness of management estimates, and identifying relationships that appear inconsistent with the auditor's understanding of the business. Analytical procedures may also reveal changes in profitability, liquidity, efficiency, or solvency that require additional audit attention. However, planning analytical procedures do not provide sufficient audit evidence on their own and must normally be supplemented by tests of controls and substantive procedures to obtain sufficient appropriate evidence supporting the auditor's opinion. Ratio analysis forms a significant component of analytical procedures because financial ratios highlight relationships between financial statement elements and facilitate comparison across reporting periods and with industry benchmarks. Common profitability ratios include gross profit margin, operating profit margin, and return on capital employed (ROCE, which assess operational performance and efficiency. Liquidity ratios such as the current ratio and quick ratio evaluate the entity's ability to meet short-term obligations. Efficiency ratios include inventory holding period, receivables collection period, and payables payment period, providing insight into working capital management. Solvency measures such as the gearing ratio and interest coverage ratio assess long-term financial stability and financing risk. Significant deviations from prior periods or industry norms may indicate areas requiring further audit investigation. Interpretation of analytical ratios is equally important as calculation. For example, a declining gross profit margin may indicate pricing pressures, inventory valuation errors, theft, or incorrect cost allocation. An unusually high receivables collection period may suggest impaired receivables or fictitious sales, while declining inventory turnover could indicate obsolete stock or overvaluation. Increased gearing may raise going concern concerns, whereas significant improvements in profitability without corresponding business explanations may suggest revenue recognition issues or understatement of expenses. Auditors therefore combine ratio analysis with knowledge of the entity and professional skepticism to identify areas of heightened audit risk and design appropriate audit responses. A thorough understanding of the entity, its environment, and its financial reporting framework, supported by effective analytical procedures, provides the essential foundation for risk-based auditing and the efficient conduct of a high-quality external audit engagement.